Dividend investors, bonjour! Mike Yehou here, founder of Dividend Stocks Rocks, passionate investor. I hope you're doing well today. Last week, I've covered two of my favorite US dividend stocks for 2022, which were air product and chemicals along with innovative properties. This week, we are covering two Canadian stocks. The first one, let's dive right into this project, GoEasy, ticker GSY.TO. This company is a non-prime consumer lender. What does that mean? Is that you have like top-notch clients with amazing credit bureau and a great job and low debt, and then right below that you have the non-prime consumer. So those had maybe like some difficulties, or at one point they went into a little bit too much credit, but still they can manage their stuff. They have a credit score that is relatively good, but not stellar. And this is probably where you can find the most added value. So all banks go for the top-notch client, and right below that, there's definitely money to be made. As you can see, pro rating of 4, dividend safety score of 4. So you can expect high single-digit to double-digit dividend growth rate, which is kind of interesting. This stock got killed over the past 6 months, so it went on a crazy hype during the pandemic, but now it's kind of like slowing down. Some people are taking profit, and it makes it a great candidate for your portfolio today. So let's dive into what they are doing. Actually, a very interesting point here is they're showing this crazy graph in their investing presentation showing 19 years of consecutive growth. Most importantly, as you can see on this graph, is most of their metrics grow by double digit. It's important to note though that the most of their growth started around 2013, 2014, when Easy Financial and not Easy Home actually took off and started to be the biggest part of their business. So you can see the growth on the graph, and at this point, Easy Financial is more than 3/4 of their business. So it's really not about Easy Home anymore. It's really about Easy Financial. But what do they do, right? Like, what exactly the difference between both? Let's take a look at that. So let's start with Easy Home, which was like pretty much just started, and no, they are not doing mortgages. They're actually doing leases to acquire stuff such as home entertainment products, computers, appliances. So pretty much all the things that you want to have a new living room, or you want to do some kind of like renovation and you want to put in new appliances in your kitchen, well, and then you're running short on cash, well, they will offer you to either finance your purchase or to lease it until you can purchase it. So this is a great way to have some good credit. However, it's not a big part of their business now. It's only 22% of their revenue from 2020, and you can expect that in 2021, 2022, it's probably going lower. So what's really interesting is Easy Financial. So here we're talking about secured and non-secured loan. Not necessarily too much. We're talking like $500 to 15, and then if you're securing with an asset, you can go up to $45,000. So small loan, a lot of underwriting process here, a lot of credit to be made. But then this is how they have succeeded to. Sometimes, you know, those products are probably like too small for the big banks, and they rather go after wealth management clients or big mortgages or commercial businesses. And what you're looking for Easy Financial is really like, you know, like small loan that could get easily approved. You can do them online, so it's quick. You get your money fast, and then you can start paying it off quickly. I'll be honest, I was a bit skeptical when I first take a look at GoEasy a few years ago. First, because this is the type of company that looks good on prom night. This is the type of company that will do amazingly well when the economy is booming, because everybody has jobs, the interest rates are low, so consumers keep borrowing stuff and they can afford to pay back. But then when we enter in a recession, I was expecting GoEasy to have a lot of problems, but actually what I didn't expect and what was surprising, and this is why I like the company now, is they have proven that they have a very strong underwriting process. So basically, as you can see on this graph, they lend money to the typical Canadian for typical reasons. Can take about debt consolidation, auto repair, home repair. So most of the time, those are like not necessarily like expenses that are building up or unexpected expenses that at one point you have to pay back. Most of their clients are in their 40s. They're making close to $50,000 a year. They've been relatively stable in terms of employment. So that's pretty much a good base when you're looking for the consumer, that like the perfect consumer for such small loans. So they qualify their clients with stronger financial metrics. So the revenue is slightly under the Canadian average. However, they pick on clients that has a lot less debt, which is pretty good. So lower debt level and better debt ratio, which give a little bit more room, and especially if there's a recession and like people are losing their job, they're still able to pay back their loans, and especially when there's like smaller like this, it makes them a good cushion. And this is what we have seen during the crisis of 2020, 2021, where the provision for credit losses weren't catastrophic. It shows that even if they took some bigger provision for those years, and even if they showed larger provision for credit loss during those times, they still showed a good capitalization, a healthy balance sheet. It turned out that this company is also able to increase its dividend year after year. They have actually done quite an impressive route in that regard. So since 2014, we're talking about 34% annualized growth rate, which is kind of crazy. Don't expect that in the future. At DSR, we expect like high single digit to low teens increase in the coming years, and then it's gonna probably like slow down a little bit, probably around like 5-6% as other regular financial institution, but that's gonna take a few years still. So you can enjoy a few more good years in this point. So one of the reasons why I took GoEasy for 2022 is because my bet on Canadian economy is that it's going to continue to do well. Even though we expect interest rate to increase, it's actually going to help GoEasy making more money on their future loans, which is going to be good. And I think that the economy is resilient enough that it will not slow down the consumer sentiment and this hype around having the need for changes and the need for consumptions, and then GoEasy is right there to fill up that need. As you can see on the dividend triangle, we can see a great progression no matter what happened over the past 5 years. Revenue, earnings, and dividend are directly through the top. But then again, we had a company that was trading at a much higher price not too long ago, and now around $150. This could be a great addition. Yes, we're talking about financial stock. I could have done another video on Canadian banks because definitely they are my favorite in that sector. But at one point, I just wanted to be a little bit more original. I wanted to talk about another type of company, and actually, I think GoEasy could be a good complement in your portfolio if you already have some Canadian banks and you're still looking to increase your exposure to the financial sector. This could be a good candidate for that reason. Before we move to the second pick, just make sure that you go right below. You download my best stocks book for 2022. I've put 6 other stock picks in there, so you have a little bit more ideas for the year. We're covering US stocks, Canadian stocks, and speculative plays. And also don't forget to give me a thumbs up and follow this YouTube channel, because next week we're going to cover 2 speculative plays that are quite interesting. Actually, I own both of them, so if you're curious, stay tuned for next week. But now let's move on to my second pick for 2022 on the Canadian stock market, which is Intertape Polymer. Intertape Polymer, I mean, if you think about duct tape, there you go. You found the company who makes the famous duct tape. I just love it. I mean, I had an RV for a few years. I traveled a lot with it, and my best friend was definitely this roll tape. The company has a lot of brands. They're number 1 or number 2 in North America for most of them, which is great. So leader in the market, good dividend yield. We're talking about something close to 3.5%. Been increasing its dividend for the past few years, so since 2019. And an interesting fact, they are paying a dividend in US dollar. Now, looking at their type of products, they cover a wide variety of products and a wide variety of industries. What is interesting here is that you don't only have like regular tape, but you also have tapes for food, for air pillows, for house wrapping, so all kind of different ways. But this is great because since they produce so many different type of products, it also offers them a lot of cross-selling abilities. The company has been growing through several acquisitions, and their model is quite interesting because they have this bond with their clients, and their clients needs this type of product. I mean, if you're a shipping company on online, or you have an online business and you rely on those boxes to ship your products, you need boxes and you need tapes, because if you don't have tapes, well, obviously your goods are going to go all over the place and your clients will not receive them. What I like also about Intertape Polymer is their diversification. They serve various industries, and as they acquire new product, it's easy for them to go back to their client and then offer another cross-selling promotions for them. Say, hey, have you tried like this type of tapes or other type of product that we have? And keep in mind, this is a highly fragmented market, so there's plenty of room. There's plenty of like tiny companies specialized in a specific type of tapes, and Intertape can easily do bolt-on acquisition, meaning that they buy in the same industry that they're operating with, but they're getting another set of clients, they're getting another set of products, and they can bundle that together and make them accretive, so starting to make money right away after they integrate it. This is a great image showing you all kind of products that are applicable. So pretty much whenever you go, you're actually going to see those daily usage of tapes. I like the fact that it's a repetitive purchase good. So if you're in that business, you keep needing tapes all over again all the time. Obviously, when the economy goes well, they're going to produce more. So that's another growth vector. They're going to follow the economy at the same time. They are now classified under basic material, but it could also be considered as a consumer discretionary, sorry. Mostly because if consumers are buying a lot, tapes is going to follow, and sometimes they're going to be like larger purchases, so this is where the tapes will kick in. When you look at the dividend triangle, the company made major acquisition a few years ago, and this is why the dividend does not increase all the time. So you have to consider that when you buy into Intertape Polymer. Yes, they have showed a few years of dividend increases so far. However, it's possible that at one point they will make a major acquisition and the dividend growth will be put on pause. Several years ago, during the financial crisis of 2008, the company has been forced to cut their dividend. They were actually this close to bankruptcy. And this is very important to understand why, because now the business model is completely changed. Back then, they were highly dependent on the cost of raw materials. To this date, this is still true. We're talking about like 60% of their expenses is linked to cost of raw materials, which is huge, right? So whenever it increases, it squeezes their margin and it makes them very hard to go to do business and still be profitable. What they have changed, because they have learned from that lesson from 2008, is today they are able to increase their price because they have strong pricing power, great brands, and they have built this strong bonds with clients that cannot cannot stop using Intertape polymer products. So this is the big difference today versus back then. And now they are able, and this is what they did, they are able to increase their prices to follow inflation. So even though inflation right now goes up, well, they're part of the problem because they just pass the cost of inflation to their customers. But when you're looking at an investment that could protect your money against inflation, Intertape polymer could be another great solution. So again, I hope that you have enjoyed this video. Don't forget to download the rest of my ideas in the booklet, link in the description below. Give me a thumbs up. Tell me what you think about those two companies. I'm curious if you would be willing to invest in GoEasy instead of a bank, or you would just start with Canadian banks and then add GoEasy to your portfolio. And tell me what you think about Intertape polymer. Do you think it's going to continue to increase its dividend going forward? Do you see those revenue growth keep going up in the upcoming years? I'm waiting for your comments. And until the next video, which will be again about my speculative plays for the year, stay invested.